Welcome to the Price Action Masterclass, TA's most advanced method. No matter if you're trading or investing, there are many support and resistance issues that you will face. If you use lagging or subjective support or resistance levels, that's a real problem. Misplacing key levels on the chart is also another one. One of the greatest problems with technical analysis is not knowing what zones are the strongest, and this can lead to people getting range chopped between weak levels. It's always problematic because you may not know where you're entering before you know where the key structural levels are. When it comes to entry and exit, the difference between a good entry and a good exit is absolutely your profit or loss. Many people have random entries without structure-based timing. You'll find that when you have structure-based timing, it's an absolute game changer. People just exit too early due to fear or exit too late due to greed or hope, instead of exiting and entering on structure. And many people have no clear invalidation zone. It is very easy to buy at resistance and very easy to sell at support. Many people use technical analysis indicators without really an understanding of what those TA indicators actually do. You will find that moving averages compared to structure, it's a no-brainer. Structure wins hands down, and I'll explain why in this video. A key understanding when it comes to structure is that price is not random, and one of the best things that you can do is to use CTKS Paths. I'll show you what they are and how you use them. You'll find that this is very practical learning. You'll get a rapid understanding guide. You'll have a better appreciation of understanding uptrends, downtrends, and consolidations. We'll also go through real examples. A lot of what I'm showing you is from inside the service. The last 5 months have been some of the most turbulent in-market months we've seen in many years. Not only tariffs, but so many things happening globally. When we look at Bitcoin, we must understand what the structural levels are on a month-by-month basis. We do a thing called CTKS Paths, and I'm going to explain exactly what they are. But this is the foundation of three-dimensional risk management. You will see you've got an up path for the variety of different months here. You've got a neutral path and also a down path. Many times people only assume that price can only go up. In truth, price is always moving in a wave, but it's moving between CTKS structural paths, and this particular understanding is an absolute game changer. When you understand how is price reacting and interacting with market structure, is it passing or is it failing? It is the key question that every investor and trader needs to answer. When you understand structure, you're not hoping the price reacts, you're expecting it to react. And when you get a drawdown, you'd be expecting that too, as well as rallies. Everything is structurally based. There are a lot of problems when it comes to price action confusion. One of the greatest problems is that we simply do not know where price is likely to go unless you know structure. Misreading consolidations as trend reversals is very common. Getting trapped in fake breakouts or breakdowns is also very common. Overtrading due to uncertainty or boredom, that's absolutely on the cards. And misjudging the strength of price, all of these problems can be overcome when you understand structure. There are also many problems when it comes to a lack of directional clarity. When people trade and invest without a clearly defined directional bias, and the directional bias always comes through structure. It's very easy for people to buy at the top, entering trades late in a late trend. It's very easy for people to miss the start of major moves. Structure solves these problems. Taking counter-trend trades at poor locations is something that happens very often, and failing to anticipate retracements or pullbacks is probably one of the greatest curses facing pretty much the vast majority of investors and traders. Again, it's all solved with structure. In this video, I'm going to go through CTKS levels, CTKS paths. You need 2 levels of standard certification to do it, but I'm going to take you through it and you don't need to do the certification. What's important is that you understand it. So let's get into the concept of what CTKS levels actually translates into. The first thing we'll look at is CTKS paths. CTKS paths represent the expected path of normalized price based on CTKS structure. Now, what actually occurs inside every single price chart? There are levels of structure. Some are strong, some are weak. You've got gaps in between structure. This is called a positive CTKS gap, and when you hit resistance, that would become a negative CTKS gap as well. I'm going to go through this in quite some depth and detail. But the understanding is that the chart will have a degree of structure throughout the month, and how price moves is directly associated to the structural levels. Therefore, when doing 3-dimensional risk management, we have an up path, a neutral path, and a down path. Now, these paths are all structurally related to each other. Therefore, understanding CTKS structure is quite an important thing to do. So what is CTKS structure? It is the most reliable, objective, and rigorously validated structural support and resistance market structural levels for all of price history. It's created via Level 1 and Level 2 standard certification. The best way to explain it is to show you an example of it working. It's a very good idea to think of market charts as just liquidity levels related to price action. For example, here's a specific chart. You can see there's a lot of structure. When the price was down here, you were seeing resistance, pullback, starting to weaken, starting to crack over that resistance and seek to convert it into support, but failing. But there are always safety nets below. So long as you know where they are, it's an absolute game changer. Now, one of the things to notice here, this is called a positive CTKS gap. Now, positive CTKS gaps mean that there's very little in the way of structure between major support and major resistance levels. That creates a thing called a structural overshoot, and we see it here happening in this specific chart. Now, what's important to understand, if you've ever seen those big green candles, those God candles, this is why they exist. And a lot of people don't know the underpinning market structure. So we know the underlying liquidity flows in advance. We know where price can go. We have clarity from chaos, no more guessing. Therefore, how do CTKS structural levels actually work? This gives you a bit of an indication. The stronger, the thicker, and the more clustered. So this is relatively strong, and this one is relatively strong too. Weaker levels, the intervening levels inside structure are quite weak. That means the price can just scoot up there very quickly, and then of course that structural overshoot is gradually going to get faded as buyers become exhausted. You have a lot of volatility inside these CTKS gaps. We've seen on the channel for many years, gaps inside Apple and Tesla, just everywhere. They are extremely profitable. And one thing to note, these CTKS gaps, when they're positive, such as this one, that's a positive CTKS gap, they typically get filled, but they get filled to the upside and later also to the downside. You will find CTKS structure will give you X-ray vision into key price levels, and you can trade in front of the market and not behind the market. When you see structural failures occurring and structural overshooting, you will know that more and more structural levels are required to reflect price backwards. A lot of people think that price waves are just absolutely random. It's not true. Price is always constrained structurally. We can say that a different way, that price rallies and retracements always follow structure and not chaos. If you know where the structure is, you're ahead of the pack, and you need to be. The market is made up of structural overhead resistance when the price is below, and underpinning structural support. If you get a structural failure, you get negative structural attraction to the next bucket of structural levels below. The greater the confluence in structural levels, the stronger they are, the more it can hold price. But the thing to be aware of, there are so many exogenous variables, that means outside the system, that can cause these kind of whipsaws. But these whipsaws are always based structurally. Typically what happens is people have no concept at all where the real structure in the market is. So when they see something like this, they panic and sell instead of holding on and understanding that the market rules are sharp angles reflect negative CTKS gaps become positive CTKS gaps and volatility reigns inside those zones. You know them ahead of time. The problem is, without CTKS structure, the markets do appear very erratic and unmanageable. They are very manageable if you know where the structure is. There's a little bit more to it than that. You need to read between charts, but the very starting point is to know the structure. When you're in an uptrend, what you're basically doing is seeking to flip structural overhead resistance into structural support. This is the absolute concept of buyers flipping CTKS structural resistance into support. This is in fact an uptrend. The thing to be aware of, these are liquidity zones, so as soon as price comes up, the sellers are inhabiting these levels. Stronger is always more. More sellers or eventually more buyers when it flips. It's absolutely vital to understand how price moves in between structural levels, and you can see these structural levels through here did a very powerful job of containing price, and this happens. We do it literally each and every day on the channel. Always remember that those gaps that exist inside price structure, things become more and more volatile, and you will always get these pullbacks getting into CTKS structural resistance, especially if you're seeing what we call inside the masterclass an SA or sell arc. A lot of people think, what causes consolidation? And it's a very reasonable thing to think about. When you've had a bit of an exhaustion, that exhaustion flips in between structural levels. You know these structural levels ahead of time. When you learn how to master the structure underpinning your price charts, you will see things that other people would never see. For example, all of this volatility is contained within a CTKS gap. It's up, it's down, it's all around. That is exactly what you would anticipate inside a CTKS gap. You have massive amounts of volatility. One thing to understand, in terms of price, you're always moving between buyer exhaustion and seller exhaustion all the time. So you must keep these concepts in mind around these CTKS levels. If you get gaps, the buyers and the sellers can get very exhausted in either direction. Here the sellers got exhausted, here the buyers got exhausted. When you get into ranging or consolidation behavior, what you will find is the price is moving between structural levels. Typically, how people mark up their charts, price has to print before they actually do some kind of support or resistance line. With level 1 and level 2 standard certification, the lines are already drawn in advance. This means that the way you look at CTKS structure is completely different from other methods of technical analysis. We look in terms of structural passes and structural failures. When we get a structural pass, that creates positive structural attraction to the level above. When we get negative structural attraction, it's accompanied by a structural failure. I'll get into this in more detail later on, but you can see clearly at a resistance level, you get a pullback, and there are multiple resistance levels. At support levels, you get rallies. With CTKS structure, we never subjectively do our lines. We do not do recent indicative price analysis. Recent indicative price is literally a candle prints and people draw support or resistance to or near that candle. That completely biases the analysis, and that's the majority of ways that TA is currently done. With a knowledge of structure, everything is different. For example, here and here, looking back to March, we had very clear levels of structure inside the market. If they were broken, the structure would go down lower. If they were broken to the upside, the structure would go up higher. Knowing where structure passes and fails is exceedingly important, because price will either react and the buyers will become exhausted, or price will react and the sellers will become exhausted. If you've ever wondered why you can have changes in the price paths like this, it's because of buyer exhaustion, seller exhaustion. It's a very powerful way to look at your CTKS paths. One thing to note, the CTKS paths are drawn from a positive, a neutral, and a bearish stance, and these particular paths are always based on structure. It may look like a random line, it is not a random line at all. These are all structurally based, but the structure simply isn't underpinning the chart at the current time. Only the path is shown. When you get sentiment shifts, it's basically, for example, the buyers ran out of steam, the sellers ran out of steam, and then it pretty much flatlined in March until the sellers came back and had power. What we're looking at here, and it could be any chart, it could be Forex, commodities, crypto, stock market, it doesn't matter. The structure is always present underneath the chart. And the purpose of these CTKS paths is to help you to think in terms of 3 dimensions. You're not just thinking, oh, it must go up because last month was pretty good. It must just continue to go up. But what if it went down? That is a critical thing. A lot of people just don't think about it, so they're caught off guard. Being caught off guard inside the markets is very, very dangerous to your portfolio's health. Going back to January of 2025, we see buyer exhaustion, and the price reached around that 105 mark. It came up quite well from around the 93. And then we saw for the next month, price actually decreased from about 102 all the way down. Literally, it spiked down to 78,500. This particular move had a lot of people wrong-footed. We actually looked at it inside the service before it happened. And these price paths are always drawn at the start of the month, and they are not changed. They're not fitted to price action, they are fitted to structure. What we're seeking to do is to seek and understand, is structure getting, the buyers are getting exhausted, or the sellers are getting exhausted? And if we see the structure is violated and there's a bit of a structural gap below, that can cause these cascading sell-offs, but they can come back just as quickly. Negative CTKS gap into a positive one. It's very important to understand these things. I've just currently shown you some price paths on Bitcoin and also total, but there are actually 30 other charts that we do price paths on every single month from CTKSMethod.org. If you would like to see, for example, this month's estimates on gold or silver, copper, the US2, US oil, the 10-year, the DXY, the euro dollar, Apple, Tesla, Microsoft, Nvidia, Solana, they're all at CTKSMethod.org. Trading and investing with some degree of assistance is a really good thing, and CTKS levels provide the absolute ultimate. This is a particular template from the profiting course that I'm just showing you here. What I'm going to show you is total crypto market cap, Bitcoin, and Pepe. Now notice all of this structural overhead resistance in Pepe, and look at what it did to price. Whereas if you consider at the exact same time Bitcoin was breaking out and kept going, it's a very different look. But this is exactly what structure does to different charts. It is vital to understand structure. Price action is all about structure, and when you think structure is subjective and not standardized, that's a really big problem, because CTKS structure is absolutely standardized. Many people believe that the markets are random or the markets are emotional. You will see many Wall Street cheat sheet guides about the roller coaster of fear and greed. Fear and greed is nothing. It is all structure. It always has been. Many people use traditional TA tools or technical analysis tools without a deeper understanding or context. They can learn a lot of different methods without integration. One of the key things is just to understand how structure works. When it comes to risk-reward judgment, risking too much on low probability setups. For example, if all of price action is moving into structural overhead resistance and you don't know it's there and you take it, you take the trade, you take the investment, you may have just well bought at the top. Many people don't know where the structure is, so when it comes to trading and investing, they just don't know what they're doing, misjudging the volatility near those CTKS gaps. You've seen how wild CTKS gaps are, and they are absolutely wild. High-risk structural levels are things to take advantage of, because when you have volatility inside the market, that's where you make the best buys and the best sells. And unfortunately, people trade too aggressively at the wrong times because they're just focused on herd mentality. If everybody is talking about it, you better run, not run into it, run out of it. And why is that? Well, basically because it's probably got exhausted. There's just far too many people talking about it. Okay, let's get really practical and read some CTKS structure. Now, this is literally that particular chart that I showed you before. This is total crypto market cap. Now, all of these levels are real-time and they're rightward looking. Now, what does that mean? Rightward looking is that we actually apply it like this. We know there's a CTKS gap right here. If we get a structural failure coming up into these overhead resistance levels, price across the entire crypto market could fall like a brick. This is very important to know. If you know where the structural volatility is, you can take advantage of it either to the downside to buy more effectively or to the upside to sell more effectively. Now, how do you gauge a structural failure and negative structural attraction? If a candle passes through a structural level without retracing, so it just literally cuts it and the next candle is down, that is an absolute confirmation of a structural failure. Right at that specific point, you create negative structural attraction to this area right here. So what we're saying is that when this candle broke that particular structural level around 3.34, the entire market was going to move down to $3.3 trillion. And that's what happened. When you get a lot of sellers inhabiting the market, they push price down. There's so many sellers in this area, the price didn't even get back up to retest here. It just got crushed. So that meant that there was a structural failure through here and negative structural attraction to lower levels. Fortunately, there were a few lower levels across the weekend that caught price. And then we get into this high volatility area where things can go up and down and do a lot of chopping. When you get a structural pass, it means that you're making a slightly higher high than what you did in the last candle, and that immediately creates positive structural attraction up to the level above. Now, why are we caring about structural passes and structural failures? This is a way to do your targeting. A lot of people say, oh, I like to do the target on a head and shoulders or a rising wedge or a falling wedge. You've got your targets immediately in real time with structural failures and structural passes. It is literally the structural level immediately below on a structural fail and the levels immediately above on a structural pass. This is incredible knowledge to have, and this is the entire crypto market we're looking at. Typically, people will only look at one chart, and that is their money chart that they are trading. Now, that's a big mistake inside all financial markets. To look at your money chart, if it's not, of course, it's not going to be total because you can't put any money into it. But if it's not Bitcoin, it's not total, it's something else. The problem is very straightforward. Just say it's XRP. If you were looking at XRP and saying, I'm just going to trade XRP, I don't know about total structural levels, I don't know about Bitcoin structural levels, I'll just trade XRP. That's a very, very dangerous thing to do, because if the entire crypto market, which includes XRP, and the entire crypto market is led by Bitcoin. If Bitcoin comes into a level of overhead structure, does a structural failure, and then another one through a negative CTKS gap, is likely to get an overshoot to lower levels, and that overshoot can be very horrendous. Like, for example, dropping from around 109 to around 103. That is a lot of money in terms of Bitcoin. But if Bitcoin comes down 1%, your alts can come down 3, 4, even 10% for every 1% move in Bitcoin. So an action like this could see your alt just going down by 20, 25, or even 30%. A lot of people want to use leverage inside the crypto market. The alts are already leveraged up already. What you actually need to do is just understand where is the structure and what is going to happen in terms of a structural failure, negative structural attraction, structural failure, negative structural attraction, gap filled, structural pass, positive structural attraction. You can see the entire architecture of the market when you look structurally. All that we're doing is looking at price in its natural environment and saying, are you passing or are you failing? If it's passing, it's on its way up at the moment to that 108,400. If it's failing, it's on its way down to 103 or 102,200. It is so simple. You're your own financial advisor. Now, the other chart that we were looking at was Pepe. And Pepe does like to pay. So we saw a structural failure, negative structural attraction down to the that lower support line. Another structural failure, negative structural attraction down here. Now, Pepe is always influenced on the directionality of Bitcoin and total crypto market cap. If you're not in Pepe, but you were in Solana or XRP, ADA, doesn't matter what you're trading. XRP will be influenced by total crypto market cap and Bitcoin. And we saw total and Bitcoin come down like this as well. Now, the really interesting thing to note is all of this structural overhead resistance just created a nightmare for Pepe to get through. And we would anticipate this, but if you only saw Bitcoin, you only saw total, you would expect Pepe to just romp up here and do incredibly well. But not so, because of structure. Now that you understand these charts a little bit more, you can see Bitcoin was just romping up, and what did Pepe do? It did this. Why did it do it? Because of the structure. This is completely real-time stuff. You look at the structure literally on a second-by-second basis. It is that predictive. And why did the entire crypto market bounce? Total had a lot to do with it across the weekend. Total was in fact the savior of the crypto market. If you knew intercorrelation and how to read across charts, you would have seen it. And if you did that, you would be buying around this structure and selling on the way up here. And we can notice that total crypto market cap became quite weak. Why did it become quite weak? Because of Bitcoin. Bitcoin became weak because it came into structural overhead resistance before Total did. Total's overhead structural resistance is here. Bitcoin's structure is there. This is how you read across charts. One thing to note, these CTKS paths are put up at the start of the month and they're not changed. It's all about the structure, underpinning structure of the chart. And what you will find is structure does change on a month-to-month basis. But these paths are always structurally bound. And we can see for this particular month in May of 2025, we had buyer exhaustion. And there was so much happening. For example, the Trump tariffs. Whoa, so many things happening inside market. And the thing always to remember, Price will always obey structure. If you understand where the structure is, that is your superpower. Please let me know in the comments, what other videos would you like to see done in this manner? And if you would like to do your own CTKS Paths and your own CTKS Structure on your own charts, you can do Level 1 and Level 2 standard certification. You will find it's the most valuable thing you will ever learn. And always keep in mind, reading across the charts is really important. I showed you how Total and Bitcoin move together to influence Pepe, but they influence everything inside the crypto market. So if you were in XRP and you were disregarding total crypto market cap and Bitcoin, you would be in a lot of trouble because you wouldn't understand if the market, the entire market, was coming into support or resistance, how strong that support or resistance was. You could easily buy at the top or sell at the bottom. Trusting structure is your best strategy. There are a ton of free resources at ctksmethod.org if you'd like to hop across there. And please let me know what other videos you'd like to see like this. Bye for now.